Hey everybody, this is the Real Estate of Life with Kevin Rouse. This week we talk multi-family financing with Waylon from Citibank. We talk about all the qualifications you need to get finance for apartments and really just commercial loans in general. So DJ, hit that music, please.
Support for this program comes from the Digital Broadcasting Network, presenting podcasts and web series from everyday people who have an extraordinary passion to make the world a better place.
Hey everybody, this is the Real Estate of Life with Kevin Rouse and friends. And this week we're going to talk about multi-family financing with the man, with the plan and the financing and the money. His name is Waylon. He works for Citibank. And I'm just so glad he agreed to do this. We're doing this virtually again. As you can see, I dressed up really nice for Waylon, even though he didn't go to UT. He went to University of North Texas, but it's okay. Texas is in it somewhere. Waylon, welcome to the Real Estate Life. How you doing, man?
I'm doing well. Thanks for having me on, Kevin.
Hey, I appreciate it. I wanted to have Waylon on to talk about multifamily financing because he and I just did some deals together, and I thought it was important for people to know. I know I've talked about it in previous podcast before, but I talk about it from a broker's perspective. And so I wanted to kind of talk about multifamily financing with somebody that actually puts packages together and goes to loan committee and he begs for his clients and he gets deals done. At least that's what I think happened. I'm not quite sure. But before we start that, give everybody kind of your background, Waylon, kind of, how long you've been doing this and things of that nature.
Sure. Yeah, I've been in this for 12 years now, all with Citibank Texas. Started as an underwriter and quickly moved into a lending position. During the downturn, I handled foreclosure work for our bank and workout scenarios, so I got a pretty good dose of kind of what not to do in real estate financing. And then at the end of 2012 and going into 2013, I flipped my hat back over to the production side and started working with new clients and doing new deals. So I've been back on the saddle doing new deals since the beginning of 2013.
Gotcha. And so I actually met Waylon through a client of mine who has done a couple deals with him that I sold my clients. So I think Waylon has actually financed two of the deals with that particular client. That I've sold to that client. And so, Waylon, as we get started, I guess what I would ask for you is when someone contacts you and say, hey, I want to buy a multifamily property, what are the things that you typically tell them in general, not specifics yet, but in general, as far as financial qualifications and things of that nature that they need to purchase when you're having those initial conversations?
Yeah, sure. I mean, in general, the conversation usually starts with kind of their entry into multifamily. If they've done it before, what their background is. That's the bankers always want to know what the experience level of the borrower is, first and foremost. If it is their first deal, what led them to multifamily, what got them to that point. And then once you get past that, you start talking about the deal and what drew them to that specific deal. If it's the yield they're getting on it or the upside on the value add and what have you there. Do you want to talk about qualifications?
Yeah. But you just said something I want to ask you a question about because I get it a lot as well. A lot of times I have an engineer or a doctor or someone that's been, financially successful and they want to get into multifamily investing, but they don't have the experience in buying a 20 unit or 25 unit or 30 unit or whatever the case may be. And so you mentioned something good there as far as the experience is concerned. What I tell them is that if you go to a bank, they're going to want that experience to lend. So you may have to bring that experience along either with a more experienced partner or with a management company. And so I just want you to speak to that before we get to the actual qualification.
Yeah. And you've hit the nail on the head there. I mean, you obviously are experienced yourself in working with lenders and you know what we like to see. So, what a lender is always trying to do is look for perceived risks in the loan with the property or with the borrower and mitigate those risks. So if you have an inexperienced borrower typically the ways to mitigate that risk are for him or her to bring on an experienced partner or to bring on an experienced management company. And obviously that's always coupled with their financial backing as well. You know, if someone has a very strong balance sheet, net worth and liquidity standpoint, obviously they can cure a lot of mistakes with that balance sheet. And so that, you know, that gives them some runway too that we look at.
So as you talk about specific qualifications, what do you look for in your clients that are purchasing? And we're talking about multifamily, but this really, I think, is generally commercial loans in general. I don't think there's a huge amount of difference as to what you guys look for. So.
Sure. Yeah, I mean, typically a commercial loan, multifamily included, you're looking at a minimum down payment of 25%.
Wait a minute, not 100% financing? Let's end the podcast now. No, I'm joking.
Yeah, 25% down payment. And a lot of times, you know, people will say, okay, I've got 25% down payment to put toward the deal. But what the banker is really looking for is for you to have liquidity of closer to 35%, because you want to see a 25% down payment. But we also want to see that you've got some cash reserves, a cushion, just in case operations don't go quite as well, or there's some unforeseen circumstances. So, you know, if you're sitting on a $250,000 and you're looking at that $1 million deal, that might not be quite enough liquidity, even though you technically have enough for that down payment.
Real quick on the liquidity, Samuel. So let's use that as an example. $1 million deal. I got $250,000 I can put into a deal. The versions of liquidity, I've had people say, well, hey, you know, I don't have quote unquote cash, but I own 5 other properties, you know, outright or whatever the case may be. Is that a mitigating factor, or because those properties are not liquid, you don't necessarily?
Yeah, I mean, it's really liquidity, but if they do truly have free and clear properties or other access to liquidity, say they have a line of credit against those properties, or sometimes we can set them up with a loan against those properties so they have access to that liquidity. It's all about the access to liquidity that they have. So we typically are talking about true liquidity, cash, stocks that they can access in a day or so. If they don't have that, I have been able to tap into some equity in other properties in order to provide that liquidity for them to a certain extent.
Got you. So 25% down, and what else? What other type of qualifications?
Yeah. So on the personal side, you know, we like to see a minimum net worth that's equal to or greater than the loan amount. So you know, if they're $1 million deal, want to see at least $1 million net worth going into that deal. And then we also, depending on what the deal is, we typically like to see that they have outside income that kind of satisfies all their personal living, so that they're not really having to live on this deal, that this deal is going to sustain itself. There's going to be cushion for any kind of operational downfalls or any kind of debt service payments that need to occur, but you're not making your house and car payment off the deal. You're able to do that through outside sources. Of course, you can grow to a point where your real estate portfolio is your outside source of income, but we never want to see that your first real estate deal is going to be what you count on for your living expenses.
So to that point, and for those that are not familiar, debt service ratio is for those that bought a house, that's your debt to income ratio, just stated as a commercial term. So do you or have you ever counted someone's outside income, especially high income individuals, as a part of their debt service, or do you only look at what the property is producing and can it cover?
Well, to answer that question, we always look at both. So we call it the global cash flow. So we look at the outside income and the property. And, you know, that's how we get comfortable doing bridge loans. Something we specialize in is a bridge loan where a property does not currently cash flow. It needs significant construction, make ready. It may be 50% occupied. You say, well, how can you lend on that? It's not gonna service the debt. Well, that's where you look at the global cash flow. You look at the outside income of the guarantor to bridge that gap. We do always want to see that at the end of the day, whether that's a year down the road or 2 years down the road, that property can sustain itself. But we count on that guarantor for any kind of interim cash flow difficulty. If they're buying something that's simply not ever going to cash flow, it's probably not something of interest to us. We want to see that it's going to cash flow at the end of the day, and typically that's something they want to see too.
Well, let me ask you this. So comparative to, I'm sure you can compare because I'm sure you won deals and lost deals to other banks. Where would you say you guys are just in general as far as your underwriting, as far as conservative versus more liberal or things of that nature? Are you somewhere in the middle? Are you relatively conservative? Or are you relatively liberal? Where would you put yourself on that spectrum?
Well, you'll never hear a banker or a bank say that they're the aggressive one. I've never talked to a bank and they say, "Oh yeah, we're aggressive. We're just making these loans that no one else will make." I mean,
right.
No banker's going to say that. And there is a spectrum. So, there's the large banks of the world, say the Chase Bank or the Wells Fargo or the CITI. I'm at CITY, which is
I always have to explain that, by the way.
Very small
in
comparison to CITI, where they would say, well, no, we wouldn't make a loan on a 1970s multifamily, no matter who you are, what it is. They say, oh, that's too risky. And then you follow that spectrum down, and where we fit in, we're a community bank. We're 20 location bank in Texas, and the way that community banks are competitive is we work in these spaces that maybe those big banks don't want to work in. And so compared to the big banks, we would be considered aggressive by comparison to them. In the scale of community banks, I would say we're right in the middle, that every bank has certain features of loans that they're more aggressive on just because maybe they have some personal experience with it or they have had success with that in the past. And that's where I think where we're most competitive are on these value add deals. That's something that I've personally done a lot of at the bank. Our bank's done a lot of it, and we've had a lot of success with guys that are taking on properties that need a lot of work. I mean, we just approved in committee a property that the bottom floor flooded, so the property was only 50% occupied. The whole bottom floor was vacant. But we were able to see, hey, the top is 100% occupied, even though the property is 50%. We've got a guy that knows how to do the construction, that knows how to run the property. Let's take it on. And I would say there's a lot of banks that just would have said absolutely not from the get-go.
Yeah. So that's my experience. And it's not necessarily commercial for Citibank. This is for global. But my experience with y'all is that you will do multifamily is not something that you guys are scared of, and definitely not multifamily that's either older C-class or needs work. And in fact, I guess I could ask you this question: on deals like that, how do you typically structure those construction costs within a deal? I don't just as an example, that particular deal flooded the bottom floor, so he has to do some construction. I don't know if he's going to pay for it out of pocket or he put that in the terms of the loan, but I know you and I did a deal very similar to that as well, where there was some construction that needed to happen to kind of bring that property up. So how do you typically structure those deals?
Sure. So the typical structure is we'll loan up to 75% of the total cost, and that would be the acquisition of the property plus the construction budget. And what will happen, the mechanics of that will be that at closing, the borrower will put in all their equity of the project. So just to use numbers, let's say you have $1.5 million purchase and it needs $500,000 in repairs. It needs extensive repairs. So you've got a $2 million project. So the 25% that the borrower will have to put in, which is $500,000, that'll go in when we close, and we'll basically hold back as future advances on the loan, just like a construction loan for any property. that $500,000 will release that money to the borrower as he completes those repairs. So he'll go and do the first set of repairs at maybe $25,000, $30,000. He'll request for a draw. We'll send out an inspector, and we'll fund that $30,000 to him, and he'll continue the project until he's done with it.
Yeah, and so, and I'm just going to ask you this, but not ask for a question yet. You mentioned that you were so I got my claim to fame is I used to sell foreclosures, residential foreclosures, for 5 years in Houston, had a contract to do so. Now I work for 4 bankruptcy trustees where I sell properties that are companies that have filed bankruptcy. And so you were in the workout department. So I'm going to ask you this now, then ask you to answer later. I would be interested to hear some of the more interesting general stories of where you see people make mistakes, having worked in foreclosures in the workout department at the at the bank, because I'm sure that gives you a different perspective on how to look at a deal. Now, before you answer that, I wanted to ask you, what are you seeing right now as far as the market in terms of lending? I noticed in obviously 06, 07, 08, banks were tight. You had to put down 100% and they might give you $1. I'm being funny. Like it was that tight. Banks were really tight, and so the economy's been doing relatively well. To me, it's slowed down a little bit, at least in my little world, as it pertains to just deal flow. So, what are you seeing out there as far as underwriting? Are folks are kind of staying stable, or is it kind of tightened up a little bit, or is kind of status quo from last year?
Yeah, I would say it's more or less status quo. But one of the dynamics that has occurred is with the market shifting to where there's probably more buyers than there are deals.
Way overall. More. I can attest to that. There's way more buyers than deals.
So the way the lending has changed is that, say back in 13, you could find a deal, and a lot of times you could find a deal that's knocking on a 10 cap. I mean, it's up there 9.5, 10 cap. And so there was no cash flow issue. The lender would pick up a deal, and you're going to put 25% down. Man, the cash flow is going to be great. Your debt service coverage ratio will probably be somewhere close to a 1.6 when our minimum requirement is a 1.25. So what has changed now is that cap rates have compressed to a point where for some of your nicer deals, if they're trading somewhere at the 7 or below cap range, there's simply not enough cash flow there to service the debt on a typical bank loan with only 25% down. Sometimes it needs 30% down. Sometimes it needs 35% down just to generate enough cash flow to make the bank comfortable that you're always going to be able to make that payment. So the loan to value, you might say, oh, the banks become more conservative. It's really, we still have the same requirements. It's just the deals have forced us to become more conservative. And I think it's one of those lessons learned that you can't just look at value. You can't just look at cash flow. You got to look at both in order to be safe in a deal.
Do you feel because of that the market is a little bubblish?
It's hard to say. I mean, I feel that sometimes, but I'm definitely no economics.
Right. No, look, if we both knew the answer to that, we'd both be doing this from Tahiti somewhere.
But so you have to look at much more than just history. You can't say, oh, because this is a 7 cap and it used to be a 10 cap, it's overvalued. You're really looking at what's going on in the global marketplace, what alternative investments are out there, what kind of liquidity is in the global marketplace to really determine if it is bubblish. And that's a better question for the Mark Dotzers of the world and the Ted Joneses of the world. Those are the economists that can tell you. And I recently listened to Mark Dotzer, and he does not think it's bubblish. He thinks that workforce housing, DNC multifamily is one of the best investments there is. there's a declining supply of it. It's something that's of ultra need and becoming more of need as time goes on. So he thinks it's more of a normalizing of what that stuff's really worth.
I agree. I always tell people, regardless of the market, B and especially C is a good investment. And the reason I say that is because when the economy is good, people move up a rung as far as renting is concerned. So the C's go to B's and the B's go to A's and the A's stay where they are. When the economy is bad, everybody moves down a rung, but C is right in the middle. So, even though you might have to discount rents a little bit in a tight market for a C, as long as you manage right and manage your rental rates right, you should never be in a situation where you're struggling for occupancy.
That's right.
Yeah, so that's a safer investment. And I believe, and I'm not an economist, I just play one on this podcast, but I believe that the development of, I know it's technically A because it's new, but the development of basic, safe, clean, B housing, multifamily housing is an area of great opportunity for those that have the liquidity and to be able to develop that.
Sure.
Yeah, not the sexy A stuff, but just, hey, a little kiss of granite here, but really it's just a 2-bedroom, 1 bath, a nice place to stay. With that being said, how do you treat, I get this question all the time, how do you treat partnerships? As far as, 3 or 4 partners or 2 partners, when they want to purchase something from an income, how you look at that globally standpoint, what does the bank require? Who has to sign the note? Who doesn't have to sign the note? Things of that nature.
Sure. I mean, everything in life is up for negotiation, but I'll tell you how we do it 95% of the time.
Sure.
If there's a partnership, we require every partner that owns 20% or more of that entity to sign as a personal guarantor. We look at every one of them. We look at their balance sheet, their income, tax returns, and their background, so credit and background. And we like to see that all those partners are solvent and are in a position to take on the partnership. Sometimes you would say, well, if there's one guy who's well off enough to do it on his own, he just so happens to have partners, then why do you care about the other partners? And that is a good argument, but there is partnership risk. And this is something I saw during the downturn where you can have partnership disputes. And if you have one partner who is very well off and is not as affected by a downturn, and you have 2 other partners that are, and it comes time for capital calls, well, even though one partner may have $1 million and they're needing to have 100,000 injected into the partnership, well, the $1 million guy wants everyone to put in their fair share. And so it creates a dispute where it could lead to foreclosure just because the other partners can't come up with their share of what they need to do. It's really unfortunate, but it does happen. For the most part, though, if we do have a well-off partner and he's bringing on some other partners, we give much more credence to having that well-off partner. We'd rather see a partnership that has at least one high net worth partner, and then maybe some other guys that are getting their start, as opposed to a partnership that's full of guys getting their start and they're all just kind of barely hitting the benchmarks we're looking for.
So, I was just about to ask you, how do you treat unequal partners? And so you just explained that, because a lot of times that is the case where you have a really strong, high net worth individual, and then you have someone either getting their start or just not as strong as far as that. But they're both signing the deal. So for those limited partners that are less than 20%, do you gather any information about them at all, other than the LLC paperwork, or do you gather any financial information about them?
Typically not. If they're going to be signers on the account, there are some know your customer laws, banking laws. We kind of have to know who we're dealing with. But beyond that, if they're not signing as a guarantor, we typically don't get any financial information from them. It's just we just don't need it. The times where that may not be the case is that there's a lot of them. Let's say a large syndication, and there are 20 partners that each own a small percentage. We might want to see information on one or two of those just to kind of know who we're dealing with.
Gotcha. So going back to that question about, you worked in the workouts department. Are there any stories or anything that you learned, that would help people out there that are listening, of what to do or what not to do, or just, some craziness like don't ever do this or whatever the case may be?
I'm trying to think of the don't ever do this scenarios. I mean,
other than lie and commit fraud.
Yeah. Obviously don't commit fraud. I mean, it's, a lot of it was just, there was a lot of lying and fraud involved with those workout scenarios, and that's why they got to that point. And a lot of times it was guys that weren't treating their contractors correctly, or a lot of times those guys find themselves working with contractors who are also dishonest. Dishonesty kind of breeds dishonesty.
Mm-hmm.
And so there were a lot of contractor disputes where contractors weren't getting paid, or stuff wasn't being constructed correctly. Guys getting into projects, and this goes back to the cash flow and value metrics that I was talking about, where some people were building things and saying, oh, it doesn't matter if it cash flows, I'm going to be able to sell this for a 15%, 20% profit when I'm done with it, or I'm going to be able to refinance it. And in that 18-month time frame, once they were done with it, that market wasn't there. And guess what? You can't rent out a $400,000 condo for enough to pay the debt. So
I still think that's happening on the townhome, at least here in Houston market. That market is sucking wind right now from my vantage point.
Yeah. So it's I think having multiple exit strategies is key. There's some property types that you're building spec houses or spec townhomes. You're not going to have multiple exit strategies, and I think what you have to do in those scenarios is just watch your leverage and make sure you're not putting so many on the ground that if you see a little downturn, you're able to exit those. And even if you take a little loss, you're able to exit them, get some of your money back, and live to fight another day. If you get to a point where you have $10 million in product on the ground and you only have a couple $100,000 to your name, you only have one way out, and that's bankruptcy. I mean, it's just not going to be easy to work out of those deals if you get to a point where the market's adjusted 10 or 15%.
So real quick, even though this is multifamily call, are you seeing, we have compressed cap rates on the multifamily side. Are you seeing, I have clients that are looking for yield right now. So they're coming to me for multifamily, but we're looking at, retail and industrial, because those cap rates seem to be a little bit quote unquote better, even though they're a tad bit riskier because you're more tied to the economy. So in your lending, are you seeing that as well, that people are looking for those other markets because the cap rates are a little bit better?
You said other markets?
Like other product types.
Oh, product types?
Yeah.
I do see it. It's I see more people going to other geographic markets looking for yield, and there's some risk there that maybe they're not recognizing that. Obviously, there's because
by the way, people, he does deals all across Texas, but he sits in Dallas. So
yeah. So obviously, thousands and thousands of people are moving to Texas but they're coming to Houston and Dallas and Austin, the major metros, and some of the tertiary markets, don't have that dynamic. There are still markets in Texas that are shrinking in population, and you say, oh, I can go to this town in West Texas and buy this property at a 10 cap, and it has this dynamic of, well, it's a 10 cap today, because you could look up and have a rent decline, just population decline. it especially happens in the oil markets. I mean, you see the booms and busts of the oil cycle. And I'm not talking about Houston. I'm talking about where they're drilling,
Right.
West Texas, that these guys can fill up man camps, little mobile homes, and generate all kinds of cash flow. And they would happily sell a lot of those at a double-digit cap rate because they know that it's not going to last forever.
Yeah, the bond is going to be due. In fact, there's a deal now.
I see more people going to new geographic areas than because all the product types that I see are pretty compressed in cap rate. I mean, self-storage, industrial, even mobile home parks. I mean, everything you can think of is a good 2-3% lower cap rate than people think it should be.
Yeah, and when I say better, I say slightly better. I'm saying kind of CB class other product types. But again, if it's I just did a small industrial deal, and it's a better cap rate. But also if the economy goes crazy, then that's a risk. To me, that's a riskier investment than multifamily. At the end of the day, the thing about multifamily is people always need a place to live. Shelter is one of our basic needs. So as we get ready to wrap up, what I was wondering, Waylon, is what do you like to invest in? What's your portfolio? Either portfolio or what are you interested in investing in?
So right now, all I'm invested in are single family homes. I got into that a few years ago. For a few reasons. It was just kind of easy to get into from a financing perspective, from just a dollar amount perspective. You could come up with $20,000 or $25,000 and put it down on a $100,000 house, and you have a rent house. Mm-hmm. And so that entry point was just a little less daunting than trying to take on a multifamily. Obviously, I'm interested in multifamily. I've just never done it. I think the next step for me is likely to invest passively in multifamily partnerships. So there's a lot of groups that do that around town that teach people to raise money to invest in multifamily. And with my full-time job, I work so much that I really can't take my eye off of that and spend the time that it takes to become a good operator of multifamily. Mm-hmm. I think that's a art. It's a craft that guys really need to take, not full time. I mean, some guys can do it, but it takes a lot,
man,
to get to that point. And so I'd rather just find those guys and trust my money with those guys than try to figure it out myself. And maybe I get to the point after I see kind of behind the curtains everything they're doing, then I might get to the point where I do one of those partnerships.
Gotcha. So, Waylon, if people want to get in touch with you, how do they find you? What's your home address and home phone number? I'm just how do they find you if they want to get financed?
So I will get my cell phone. That's the easiest way to reach me, and I get enough robocalls anyway. I don't think it's any secret anymore.
True.
So my cell phone is 469-474-9089.
Repeat one more time.
It's 469-474-9089. As Kevin said, I am in Dallas now. I was in Houston for 5 years and grew up in the Dallas area, so I'm back in Dallas. So that's a Dallas area code. You Houston folks don't hold it against me.
He's also a Cowboys fan, and don't hold that against him.
I don't know about that, but I love both cities. I love all of Texas. And then my email address is WTHEMER@CITY.BANK. And the BANK, that's our domain. A lot of banks are switching to that domain. It's a more secure domain for the banking industry. So it's WTeamer@city.bank is my email address.
And as always, everyone that listens or watches the video, you can always contact me if you didn't get that, and I can forward Waylon's information. Waylon, I appreciate you, man. I really do. This is Good Friday. Waylon in there, like all of us in there, we're making those calls, we following up on those deals. That's how you know you're dealing with two top producers. You know what I'm saying? That's how we do it. Even though he doesn't get technically off, but and I don't technically get off as well. So I appreciate you on last minute notice. People know how I am. I usually like, oh, you know what? I want to talk to Waylon. Can you be on tomorrow? The day beforehand. So I appreciate you making time for me.
Yeah, well, I appreciate you having me on, and you have a blessed Easter weekend, and I'll talk to you soon.
All right, guys. Thank you again for listening to The Real Estate of Life with Kevin Rouse, and I will see you next week.
Do you have questions about any of the topics I'm talking about? If you have questions, let me know. Email me at kevin@kevinrouse.com. Again, that's kevin@kevinrouse.com. I'm going to do a podcast just on the questions that you guys are sending me. So feel free to send them to me. Again, that's kevin@kevinrouse.com.